Hello, today let us look at the statement of cash flows, okay? This statement shows the amount of cash and cash equivalents that flowed in and out of a business during a specific period, okay? So this is basically the cash inflows into the business and the cash outflows from the business as it continues to do the operations, okay, during a specific period, okay? So first, let us understand what do we mean by cash and cash equivalents, because you're going to find these a lot in the financial statements, okay? Cash is basically the physical cash you have. You could be in your office, you have a safe where you have cash, physical cash, which you handle petty cash, okay? You have cash in bank, okay? That is still cash. You could have deposits. You have a pure savings account. It earns interest, right? Yes, but you can withdraw anytime. So you can easily access that money to use it, okay? So that is still cash. You could have a money market fund account. You see, you'd see this is an investment, but you can access that money in a day or two, or you can convert it to cash in bank very quick. So for short-term very short-term investments that you can easily convert that investment into cash, and they have a low risk, okay? A low risk. I'm not saying that you go take shares and sell them. You cannot easily do that. It also selling shares as a high risk, okay? The amount is not guaranteed. What is today is what is tomorrow. No. For like an example of money market, it is because we have a low risk, okay? In banks, you're going to find there usually overnight deposits, okay? So also the risk is very low and you can convert them into cash very quick. So you're going to find many corporations, especially banks, they have this cash and cash equivalent, but you are going to see the things that they call cash equivalent. They are things that are can be converted easily to become cash in bank, okay, or cash at hand, okay. So now let us go back to the statement of cash flow as we were, okay. So this statement basically shows the cash inflows into the business, and then it also shows the cash outflows from the business. What do we mean by this? We have a snippet here of the statement of financial position. Recall the statement of financial position basically is what we commonly call the balance sheet as well, okay? This we usually have assets, liabilities, and equity. And the asset is where we usually have, under current asset, we have cash and cash equivalent. So what this statement of cash flows is going to show is this difference from the prior period. Let's assume this is 2024 and this is year ended 2025. So this is the closing balance as at 31st December 2024, and it is the opening balance as at January 2025, right? So we want to know this net change from 5.9 million to 8.5 million, which is like 2.6 million, okay? We want to see what has been happening, what is the cash inflow into the business and the cash outflow that has been happening during that period to bring about this balance of 8.5 million, okay? You will notice here there could have been payments and also receiving money because you're doing the buying and selling, okay? So that is what we want to see. That is what the statement of cash flow shows, okay? First, before we proceed, I want us to recall one thing, okay? We usually have two main bases of accounting. We have the cash basis accounting. We have the cash basis of accounting. Then we have accrual. Okay? Remember, when you want to recognize revenue, when a business is using the cash basis accounting, what do? We recognize revenue when cash is received. So if I'm selling to you, if I'm a business using cash basis accounting, I will recognize revenue when you have paid me, okay, and I have received that money. When I receive that money as a business, that is when I recognize that revenue. But for accrual, what do? In accrual accounting, we recognize revenue when it has been earned. What do we mean by earned? If it is goods and service, if it is goods, we have delivered them to the customer. It means we've done our part. So we have earned that revenue. So we recognize revenue at that point. If it is services, we have done what we were required, maybe submitted a report or done the work. If it requires doing some work, then we have earned that revenue. Okay, so you can see the difference. So when we are using the cash basis, what we have in our statement of profit or loss as revenue is basically cash inflows, because we are only recognizing revenue when we have been paid. Okay, so when we use cash basis, then the revenue, it's basically cash inflow because we have received it, but it is not the case for accrual accounting. Okay, for expenses, for expense recognition, when you're doing cash basis, we recognize it when cash we have paid, when we have paid the supplier. Okay, when this business pays the supplier is when we recognize that expense. For accrual, we recognize the expense when it has been incurred. For instance, if you are paying your employees, and for cash basis, till you pay them, you will not have recognized that expense. But for accrual, what do? We record that as a liability in our salaries payable, and we recognize the salaries expense. Okay, so as long as something has been incurred, or rather what we were supposed to receive, if you were buying some goods, okay, if you were buying goods and we have not yet paid, we are going to recognize the expense, and then we are going to recognize a liability in the account payable. Okay, so you will notice for cash basis, it's very easy. For cash basis, it's very easy because for revenue is basically cash inflow. Expenses is cash outflow. But for accrual, you have to do adjustments so that you will be able to know which is the cash inflow and which is the cash outflow. Because from this, when you look at revenue, there could be revenue that has already been paid for and the result that is sitting in our account receivable. Same to the expenses, there could be expenses that we have paid, so there is that cash outflow, but there is also that are sitting in our account payable as a liability. So there have to be adjustment. Okay, and also remember, most corporations and companies are required use either IFRS. Most use either IFRS and GAAP, and GAAP both requires us to use accrual accounting. Okay, so if a company is preparing the statement of cash flow, that is basically as the one that is in the criteria where they are required to do accrual accounting. So there have to be adjustment so that we are able to see which are the cash flows and which are the cash the cash outflows. Okay, so before we continue, let us understand the classification of activities that are done that bring in cash flow and cash inflow and cash outflow from a business. Okay, so FRS has classified them into three. You're going to see this is the format that is even used in that statement, so it is very key. Okay, so we usually have the operating activities, and the operating activities, these are basically the activities that are basically the main day-to-day operations. If you are selling cups, this is if you are buying and selling cups, I'm expecting to see cash flow from customers and cash flow to paying for those cups, because you're buying them from the supplier. So that is a cash outflow, and then there is a cash inflow from you being paid by your customer. So cash from customer, cash you pay to your supplier, salaries, because you're paying salaries, rent that you're paying, and those the direct cost that basically what we in our statement of profit or loss, what we say are operating expenses. Okay, so this is where they sit. Okay, the expenses will be cash outflow if they have been paid already. Okay, then we have investing activities. These are basically activities that involve buying or selling, because you could be buying or selling. Okay, long-term assets. assets or investments. Okay, so if you are buying, for example, PPE, property, plant, or you're buying, it could be even an intangible asset, or you're buying land, okay, you're selling a machinery, okay, or those are basically investing properties, okay, because when you buy an equipment, you use it for some years, sometimes you need to dispose it, and you dispose by selling that machine, okay. Then we have financing activities. These are basically the activities that come from raising money or repaying money, okay, that is used to fund the business, okay. So when you go take a loan, what have you done? You're getting money to fund the business, or you go issue new shares, okay. So you get capital, you get money from the shareholders, okay. If you go pay dividends, that is a cash outflow. Because people you have shares, and you need to pay dividends to the shareholders. That's also a cash outflow. Okay, so it could be loan received, it could be loan repaid, shares issued, dividends paid. All those are financing activities. So this statement basically breaks down these activities into three. Then we are able to see the cash inflows that relate to operating and the cash outflow that relates to operating. And then we see the cash inflows for investing and the cash outflows. And then we also see the cash inflows for investing and the cash outflows. Then someone who is using that statement will be able to see, is this company is using more cash in the operating activities, or in the investing activities, or in their financing activities. That will assist a lot, especially to know the liquidity of a company. Is it a company that can pay a loan? Is it a company, do they have how is their cash management? Okay, so as an investor, you want to see that, and this statement basically represents that. Okay, so there are two methods of preparing this cash flow statement, and one is the direct method. Okay, one is a direct method, the other one is indirect method. Today we are going to look at the direct method, but before we go we look at it, the direct method is usually used by, I'll say, smaller corporations, because it is tedious, it requires quite some work, but it is very easy for an external user, because its representation is easier for someone who is reading to see, to understand how cash flow has been moving in that business. We are going to see the difference once we prepare for both, okay, using the both methods. And the indirect method is usually used by major corporations. You'll find most banks use these. Insurances, they use this indirect method, and they are required actually to use the indirect method. Basically, this one you're going to know the difference between the direct method and the indirect method is how we arrive at the cash flows for operating. Otherwise, for investing and the format we use, when you use the direct method and indirect method, you're going to get the same net for operating. It is just that the approach that we use. Okay, for indirect method, you will find that we work backward. It's like working backward from the statement of profit or loss, okay, which you're going to look in the next class. Today, let us look at the direct method, okay. So first, let us look at the structure of this statement, okay. So as usual, you usually need to write the name of the company. This is which statement, which is the statement of cash flow. Don't forget, for this statement, we are looking at for a certain period of time. We want to see the cash inflows and the cash outflows during a certain period of time. So not like the balance sheet where we are looking at the balances, okay? Remember, for the statement of a financial position, we usually look at the balance as at a particular point. But here we are looking at the movement during a certain period. So that is why you're going to see we have here for the period ended 31st December 2025, which basically means for the period from 1st January 2025 to December 2025. Okay, so this statement, the structure is, it is usually divided into 3 sections. You're going to see the first section is the cash flow from operating activities. So this is where we are going to list the cash flow from operating activities. Okay, then there is the cash flow from investing activities. As mentioned, I said there are 3: cash flow from operating, investing, and the cash flow from financing activities. Okay, so this needs to be represented. Okay, so let us start with just a second. Let us start with the cash flow. Let's have this here so that we're able to see how we record these. So here we have amount. This is where usually when we have the financial statement, especially that are, we could say this is in whichever amount. Financial statement outside here that are published, you'll find there usually notes. Okay, you'll find they have notes. They have the prior period and the current period. Okay, so this is because IFRS also requires for comparative information. Okay, but when you're looking at a question that you're tackling, this is sufficient. You say, for example, this is period ended 31st December, so this is only for the balances of 2025. But if you are looking at a statement out here for a publicly listed company or bank, you will find there is the period 2024 and they have some reference of notes here. Okay, now let us start at the first section. So cash flows from operating activities. We have cash receipts from customers. Okay, so basically, as mentioned, cash receipts from a customer, what is that? Cash received from customers, those are inflows into the business. Okay, so you include that amount. You should not be lessing it. It is an amount that you add, so you need to write that as an you're going to indicate these as a XX. Okay, let's use XX. Okay, sorry, that is in the wrong place, so this is XX. Okay, then cash paid to suppliers. What is that? That is an outflow. That is an outflow to the business. Okay, then cash paid to employees. That is an outflow. Okay, cash generated from operations. That is basically cash inflow. That is cash inflow. Then interest paid, that is cash outflow. Anything that is paid out, it's basically cash outflow. Okay, so you're going to see when we have a company that uses accrual accounting, you're not going to have these direct cash receipts from the customers. You will have to calculate it. Okay, because you will find yourself, you have to readjust for the account receivables. You have to check the ones that are we just want the ones that have paid. We don't want what is in the account receivable. Okay, we want only the ones that have been paid. Okay, so this we're going to look in an example. We're going to use an example to understand this better. Okay, so that is from it. Now we'll be able to get the net cash flows from operating activities, which could be a positive or a negative amount, depending on how the amounts that are there. Okay, so basically this is a summation of all these, the cash from operating activities. Okay, then the cash flow from investing. Cash flows from investing. Purchase of PPE. When you purchase, what happens? You are paying out. To get this PPE. You're giving money so that you get this PPE. So that is basically a cash. That is a cash outflow. Then we have proceeds from sale of equipment. What does that mean? You wanted to dispose your equipment, so you have sold it, so you have received. So that is a cash inflow. What about purchase of investment? When you purchase an investment, When you purchase an investment, what has happened? You have given out money. So that is a cash outflow. What about interest received? That is an inflow, because from what you have invested in, from this purchase of investment, you received this interest. So you've gotten cash into the business, okay? What about dividends received? Dividends received means you have maybe you have shares for another company, because this is for investing activities, remember, okay? Not financing. This is investing activities. So these dividends you're receiving is you have the shares for another company. So this is a cash inflow, okay? Then we have, so here you're going to have a total, which could be positive or negative depending on the amounts that if the cash inflows are more than the cash outflows, okay? Then we go to the cash from financing activities, okay? So, just a second. So, for cash flows from financing activities, we have proceeds from issue of shares. When you issue shares, what happens? You get capital from your shareholders, okay? So basically, we will have received cash into the business, because this is capital into the business. So basically, that is a cash inflow into the business, okay? And you can see these are things of the nature of financing or funding the business, okay? Then proceeds from borrowing, okay? This is still financing the business. So this is a cash inflow. Remember, when you borrow, yes, you will have the liability, which you are going to see in your statement of financial position. But as per the cash flow statement, we are only looking at, we have received cash, okay? Because you have taken a loan, we have received cash of this amount, okay? Then repayment of loans. Repayment of loans is when you take this of borrowings. When you take this loan, are you not repaying it? Because definitely you have an obligation to pay. So that is a cash outflow when you pay, okay? So during the period, this amount is basically the repayment of borrowings, okay? You also have a lease. If you have a lease, then you have a lease liability payment, which is as well a cash outflow, okay? Then you have dividends paid. So these shareholders, they are entitled to this amount of dividends, and you pay them. When you pay them, that is as well a cash outflow, okay? So at the end, you get the net cash from financing activities, which could be again a positive or a negative value depending on the cash inflows and the cash outflows, if they are higher than the other, okay? Then the net increase or decrease in cash and cash equivalents will basically be this net cash, okay? For operating, investing, and financing activities, okay? So you're going to have here a positive or a negative depending on which were higher, okay? So cash, I want you to know one thing, what our goal is. Remember this snippet that we had. I mentioned that when we are looking at the statement of cash flow statement, this is what we are looking at. So the expectation is if it is for this company here, this extract, the expectation is the net change should be 2.6 million, okay? This is just an example. Should be 2.6 million. This is what you should get here. And this part of the statement should assist you to know to get that, because cash and cash equivalent at the start of the year is 5.9 million, okay? And then cash and cash for at the end of the year is 8.5 million. There is another effect that usually comes, the effect of foreign exchange difference, which is caused by, for example, let's say at the beginning of the year, you had $1,000 in your account, okay? And you are, let's say, for example, you are a Kenyan-based company and you operate in Kenyan shilling. As at the beginning of the year, let's assume the Kenyan shillings to the dollar, let's assume we had 125 Kenyan shillings is equivalent to $1, okay? So, and you had these $100. Let's assume they were $100 at the beginning of the year. But at the end of the year, there has been no change. Your account still has this $100 in that dollar account. You have a dollar account, okay? But the rate at which the Kenyan shilling is trading at is, let's say, for example, 130, okay? So there has been a change because of the effect of foreign exchange. We will say here, your Kenya, because you are reporting, you're a company operating in Kenyan shillings, so you're reporting in Kenyan shillings. So at the beginning, you'll say you had a cash equivalent of 125, or rather 12,500, 125, yes. And then at the year end, you will have 13,000, but there has been no change. It is basically the effect of that foreign exchange, because your account still has that $100. It has $100 in it, and there hasn't been any change in that. You have not removed anything. You still have that $100 with you, but what has changed is the foreign exchange difference. So you will have an amount here as well, depending on whether it was a increase in change or not. So you could have a positive or a negative, depending on whether the currency has gone down or lower. So there is this, but basically the difference between these two should be equal to this 2.6 million. So if I come take this cash and cash equivalent at the end of the year, at the beginning of the year, that should be the net increase or decrease in cash and cash equivalent. So basically the statement of cash and cash equivalent shows us how cash inflows have been moving into the business and out, okay? So we are going to look at how do we calculate, especially for operating activities, how are we able to know for a company that is using accrual basis of accounting, how are we able to know the cash receipts from customer, considering we usually record revenue together, whether we have been paid or not, okay? So how do we calculate this? So we're going to do that in the next video, okay?